Hello and welcome to this Infrastructure Quarterly Update. My name's Jennifer Herbert, Head of Listed Funds at Magellan, and today I'm joined by Gerald Stack, Deputy CIO and Head of Infrastructure. Welcome, Gerald.
Thanks, Jen.
So, Gerald, what are your key observations post the September sell-off in infrastructure?
I guess the first thing we would say is that pre the sell-off and post the sell-off, businesses have been in our space, in the infrastructure space, have been performing largely as we would expect. It's been very reliable, predictable performance. There's some recovery out of transport infrastructure assets as they return to pre-pandemic type levels. And that's been reflected in the post-September investment performance. The sector as a whole, if we look at our universe, has done around about 10.5% as we measure it. And if you look at our two major components, infrastructure and utilities, so infrastructure is transport infrastructure, assets involved in the transport of people, data and goods. So utilities, regulated utilities, have done around about 10% on average through the course of that 6 months, whereas transport infrastructure assets are up around about 12.5% through the quarter. So a little bit better out of infrastructure, but no slouch out of regulated utilities either. So that's the broad theme. If we then drill down into that a little bit, there have been really three sectors that have done particularly well, and that is airports, toll roads and water utilities, and different things going on in those different areas. If we look at airports first, as the world comes back and starts flying again, as there's been a reopening of the global economy and passengers have started to return, so you've started to see that in financial performance out of airports and as a result out of investment performance. Globally, to the end of February, we don't have the March numbers yet, but globally to the end of February, the IATA numbers are that passenger numbers are down about 15% versus the same month, February of 2019. So down about 15%, and it's been progressively improving every month. But that hides very different things in different markets. The US is actually, or North America rather than the US, is actually up or down, around about 2%. So it's pretty much in line with where it was in 2019, February 2019. Europe's down about 15%. Asia Pacific's down about 26%. So very different things going on in different regions. And in Asia Pacific, it's been the tale of, it's been a much slower reopening. So it's indeed in Asia Pacific, it's really international that's dragging the chain, and international travel in Asia Pacific is down about 42%. So progressively, as different economies open up and people start coming back, we would expect those passenger numbers to continue to climb and to head back towards 2019 type levels. And IATA's predictions are that we'll get there somewhere in 2024. And as I said, we've seen progressive improvement. And if we look around then at the different types of demand, passenger demand, we see that leisure passengers leisure demand is very strong around the world. And those airports that are dominated by leisure travel, people going on holidays, actually got pretty strong numbers. So AENA, the Spanish airport system, is actually up a couple of percent and has been for both January and February of this year versus where it was in 2019. Whereas those airports with a high proportion of business travel, they're much slower to return. So we see that thematic around the world. But again, as we start to see that international travel come back from Asia Pacific, we'd expect those numbers to progressively continue to improve. And arguably, we should see that in share price performance. So that's airports. That's the first one. The second one is then toll roads. Toll roads up about 15% over that 6-month period. We've seen with toll roads that traffic came back quite a while ago. We've been running at sort of 2019 levels on traffic probably for a good 12 months for most toll roads, and that's not surprising. Ultimately, traffic in a catchment in an area is a function of the number of people who live in that area and the number of businesses that exist in that area, and none of those things have changed too much. So toll roads have come back, but there has been a greater positive vibes, if you like, towards toll roads in the last 6 months, and hence they've done well. And then the final one, water utilities, are also up about 15% through the 6 months. We see a very different thing going on there. If I was to go back to the 12 months prior, so the 12 months ended 30 September 2022, water utilities were down about 22% on average through that period. So really, quite a nasty place to be from an investment perspective. And really what we've seen subsequent to that is a bounce back. Underlying water utilities, they are regulated utilities. They earn a fair return as their capital grows in the business. They're not a place where you expect to get rich quick. And really what we've seen over the last sort of 3 or 4 years is firstly, that water utilities became extremely popular with ESG style funds globally. We saw a bit of a walking away from that theme in the 12 months ended 30 September, and now we're probably seeing a rebalance to a more normal share price levels, and hence strong performance through the 6 months. But if I stand back in total, we're seeing that the sector generally is, the companies are performing as we would expect them to, and share price performance is really following that.
And given the issues in the banking sector, what's the probability of the banks actually calling in those loans on issue to our infrastructure assets?
Well, we think it would be pretty low. You can never say never, but we would think it's actually pretty low probability of that, and for a variety of reasons. The first is that infrastructure assets at the end of the day provide essential services in a monopoly or a low competition style setting with regulated price increases. So they've got very resilient business models. Even in recessions, these are services that communities want to access and will continue to pay for. So their underlying business model is very robust. So that's the first thing. The second thing is that as we look at infrastructure assets and utilities assets around the world, we see pretty healthy credit metrics. That is, the underlying level of debt is fundamentally no different to really where it was a decade or so ago. So the debt levels are normal, very strong business fundamentals. And then they have a variety of different sources of funding. They don't rely upon any single source. There's bank funds, there's bonds, there's different private placement markets and so on. So they've been able to access debt across multiple markets, which means they're not overly reliant upon any single issuer. And then finally, the infrastructure and utilities companies have really taken the opportunity, I would say, certainly of the last 5 years, but really probably of the last decade, to extend the average tenor of their debt. So the typical infrastructure company we look at today has an average debt maturity of about 10 years. So they've locked in their debt for long periods of time into the future, which is not to say that they won't have debt that doesn't roll in the meantime, but the impact of that debt will be kind of small. It might be 5 to 10% of their total debt package. And given all the other factors that I've already mentioned, we would see the probability of these companies having a debt concern in the next little while over the medium term as being pretty low.
And inflation is a real concern for many businesses. How do you expect inflation to impact the returns of the infrastructure assets in our portfolio?
Yeah, so as we've touched on in this discussion already, these companies provide essential services, generally with very limited, if any, competition. And not surprising as a result of those two factors, they're regulated. And the regulation essentially works differently in different markets and differently with different assets, but essentially passes through inflation to end consumers. And we've seen that play out over the last couple of years. We've seen that as inflation has spiked, that's come through in toll price increases, that's come through in energy price increases for the energy companies. The energy companies we invest in transport energy. We're not actually paying for the energy itself. Similarly with water companies, as they put more capital into their capital base, and that's meant their capital base has grown, then so they've had to increase their prices for what they've done. So we've seen that play out in accordance with thesis. We haven't seen inflation be knocked back by regulators or by the companies themselves. And over the medium term, we would expect the pricing to recapture the inflation increases of the last couple of years or so. So over the long term, these companies continue to show that inflation is essentially a pass-through for them. Certainly on the regulated utility side, arguably on the infrastructure side, it's a positive because inflation is going up because demand is strong. So we're getting volume growth, plus we're getting pricing growth on, say, tolls or the price you pay to go through an airport. So you're getting both volume and price in that situation. So generally inflation is not a concern for these assets. Their earnings are growing as a result of inflation, along with underlying structural factors that are behind them.
So finally, Gerald, have you made any changes to the sectors that you're invested in, and how's the portfolio position going forward?
So there's been some changes at the margin, but it's not been too dramatic. We're around about 52% sitting in transport infrastructure, toll roads, airports, communications infrastructure and the like, and about 46.5% in regulated utilities. Last quarter when we talked about this, it was roughly 50-50. So there's a little bit more in infrastructure and a little bit less in regulated utilities. And in many respects, that just reflects the underlying performance of the assets through the last quarter. Our big allocation within infrastructure is to toll roads, roughly 26.5%, or roughly 50% of the 52 and a bit percent in transport infrastructure sits in toll roads. We think toll roads, we're optimistic about the outlook for toll roads, as we've already touched on today. Underlying traffic levels bounced back pretty quickly from 2020 pandemic situation. So we're seeing robust traffic. We think there continues to be a reason to see these assets as quite attractively priced as we move forward. So that's a significant portion of our portfolio. And then on the utility side, roughly 75%, 3/4 of the 46% that sits in the utility bucket is actually in electric utilities. And as we've touched on in previous discussions, on the portfolio, what we really like about electric utilities is, first of all, that they've got a very robust business model and they earn a fair return. But secondly, they're extremely well placed as it pertains to the transition to a net zero emission economy. For the world to get to net zero emission economy, a few things have to happen. One of those things is that we need to invest significant amounts of money into renewable energy. That renewable energy has then got to be connected to the grid. And then we've got to invest significantly amount of money in both in the distribution grid as well as the transmission grid. Electric utilities benefit from each of those 4 factors. And so as we move forward over the next 20 or 30 years, we would expect there to be significant amounts of capital invested in the electric grid, and these companies, electric utilities, should be beneficiaries of that over that time. So we're optimistic about the outlook for those companies. So as I said, a little bit more in infrastructure, a little bit less in utilities compared to where we were, say, 3 months ago, with particular focus on toll roads and electric utilities.
Gerald, thank you.
Thanks, Jen.
And thank you for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Take care.